Investing is often seen as the golden ticket to financial freedom, but it can also be a minefield of well-meaning advice and misleading myths. Everywhere you turn, there's someone offering a hot stock tip or claiming to have the perfect strategy for guaranteed success. But how do you separate the good advice from the bad? The truth is, knowing the difference can save you from costly mistakes and set you on the path to lasting wealth. Some of the best investing advice is rooted in timeless principles that stand the test of time, while the worst advice is often based on hype, emotion, or unrealistic promises. In this video, we provide examples to guide you towards smart decisions and help you avoid common pitfalls. Best, invest for the long term. The idea of getting rich quickly is tempting, but one of the best pieces of investing advice is to take a long-term view. Time in the market beats trying to time the market, and this principle has proven true for decades. Imagine two friends, Sarah and Mike. Sarah starts investing small amounts in a diversified portfolio when she's 25 and keeps her money in the market for 30 years. Mike, on the other hand, waits until he's 40 to start investing and tries to pick individual stocks based on market trends. By the time they're both 55, Sarah's portfolio has grown significantly, thanks to the power of compound interest. Meanwhile, Mike's gains are inconsistent because he often buys high and sells low, chasing the latest fads. The stock market is inherently volatile in the short term, but history shows that it has consistently grown over the long term. The lesson here is simple: stay patient, avoid making rash decisions, and let time work in your favor. Worst, follow the crowd. One of the most dangerous pieces of investing advice is to follow what everyone else is doing. This herd mentality can lead to buying into overpriced assets or getting caught in speculative bubbles. Think back to the dot-com boom of the late 1990s. Everyone seemed to be investing in tech stocks, convinced that the internet would create endless opportunities for growth. While that belief wasn't entirely wrong, the frenzy led to overvaluation and eventually a market crash. Many people lost significant amounts of money because they jumped in without understanding the underlying value of what they were buying. Similarly, cryptocurrencies like Bitcoin have seen dramatic rises and falls. While some investors made a fortune, others bought at the peak of the hype and watched their investments plummet. Following the crowd can often mean buying high and selling low, the opposite of what successful investors aim to do. Best, diversify your portfolio. Another timeless piece of advice is to avoid putting all your eggs in one basket. Diversification is the practice of spreading your investments across different assets, industries, and regions to reduce risk. Consider Emma, who invests all her money in one company because she believes it has incredible potential. Unfortunately, the company faces unexpected challenges and its stock value plummets, wiping out Emma's savings. Now, think about Alex, who spreads his investments across stocks, bonds, and real estate. While one of his investments may underperform, the others can offset the loss, helping him maintain steady growth. Diversification doesn't just protect you from losses, it also allows you to take advantage of opportunities across different sectors and markets. A well-diversified portfolio is like a balanced diet. It ensures you're not overly reliant on any single ingredient. Worst, invest in what you don't understand. A common piece of bad advice is to invest in something simply because it's popular or because someone else recommends it, even if you don't fully understand it. Blindly following tips without doing your homework is a recipe for disaster. Imagine Jack, who hears from a coworker that a particular biotech stock is about to skyrocket. Without researching the company, its financials, or the industry, Jack invests a large portion of his savings. A few months later, the stock crashes due to regulatory issues Jack wasn't aware of. On the other hand, successful investors like Warren Buffett emphasize the importance of understanding your investments. Buffett famously avoids complex businesses he doesn't understand, focusing instead on simple, proven companies. This approach may not sound glamorous, but it reduces risk and increases the likelihood of long-term success. Best, stay consistent and avoid emotional decisions. One of the most underrated pieces of investing advice is to stay consistent and avoid making decisions based on fear or greed. Markets will rise and fall, and it's natural to feel nervous during downturns or euphoric during booms. However, letting emotions dictate your strategy often leads to poor decisions. Think about Olivia, who invests a fixed amount every month through a strategy called dollar cost averaging. Whether the market is up or down, she continues investing consistently. Over time, this approach allows her to buy more shares when prices are low and fewer when prices are high, leading to better long-term results. Now contrast that with Ethan, who panics every time the market dips and sells his investments, locking in losses. When the market recovers, he's hesitant to reinvest, missing out on the rebound. Consistency and discipline are key to weathering market fluctuations and achieving financial goals. To conclude, the world of investing is full of advice, but not all of it is created equal. The best advice emphasizes timeless principles like long-term thinking, diversification, and consistency, while the worst advice often encourages short-term thinking, emotional reactions, or blind trust in trends. As you navigate your investing journey, focus on understanding the basics, staying patient, and avoiding the temptation to chase quick wins. By recognizing good advice and steering clear of bad advice, you'll be better equipped to grow your wealth and achieve financial security. Ultimately, successful investing is less about finding the next big thing and more about building a foundation that stands the test of time. If you enjoyed this video, please subscribe for more useful financial insights.